Hi, you're here with Sharon Snow and Dave Schomburg at Metropolitan Capital Strategies. We're going to start at the beginning with why should you invest in the MCS strategy. Our strategy is different than most money managers. Instead of following one asset class, like being a large cap manager, a bond manager, we have two motivating principles. We protect principal, and we're looking for double-digit annualized returns over 5-year time periods. And we have the ability to go to any asset class. We're not just managing one asset class. Thus, when we make money, it's in a stair-step approach. We make some money, we pause on the landing, and then we keep all the appreciation and make money again.
And let me just interrupt you for a second. What I wanted to add to that, that's why the certain aspect of what she just explained to you with respect to what we do and how we do it, the good news is clients really appreciate us totally when we're making them those double-digit returns or when we're protecting them against major downturns in the marketplace. However, the difficulty of our strategy comes into play while we're waiting, having to be patient for that next opportunity to make the money in a low-risk environment or to protect them against 20, 30, 40% downturns in the marketplace.
Yeah, we know there are going to be more downturns in the market, even in a more normal environment than we're in now. And we all pay for insurance on all the things that are important to us, our life, our health, our homes and automobiles. So we protect the portfolio and we make money and get paid for both of those items. So right now investors are concerned, not our investors but all investors, primarily because they don't have a context for the environment that we're in. Our parents or grandparents have a context because we, throughout history, have been in a recessionary, depressionary environment about every 80 years. And also a lot of investors lost money, whether it was in the first downturn in 00 to 02 or most recently 08 or 09. Not necessarily our clients, but if they were at another manager prior to coming with us. And really, people are always anxious to make money. I know I am, Dave.
Oh, absolutely. The psychology of long-term successful investing plays down to basically one thing, and that is patience. That is the most difficult part of what we do. Financial behavior, which is basically patience and the ability to control your emotions, both from the standpoint of fear and greed, is an extremely difficult aspect to grasp in long-term investing. Short-term, it's relatively easy because you're going to make mistakes in the short term and you think you can make up those mistakes later on. But over a long period of time, 5, 10, 15 years, you look back and you realize the mistakes you made, i.e. chasing hot money and that sort of thing, is detrimental to your long-term successful investing.
And really, what we hear in the media, I mean, let's face it, over the past couple of weeks, all we hear is that the Dow is making all-time highs. We all know that most people are experiencing a lower salary. Everything we need to purchase, i.e. food and fuel, are more expensive. Our home prices have not gone back up to the previous highs we experienced in 05 to 07. And a lot of clients do have lower portfolios. So let's look at some examples of the previous high to what we're experiencing now. This is a slide from Zero Hedge, and they put it out on March 5th. And it compares the prior high in the Dow, October of 07, to the present high in the Dow as of that exact date. So what we're seeing is that gas was $1 cheaper, GDP was 1 point higher, half as many people are actually unemployed. My God, look at the number of people increased on food stamps. And I think this is really the most important part of this slide and what Dave and I want to focus on. The Fed's balance sheet, which is part of monetary policy, was $1 trillion, less than $1 trillion, and now it's $3 trillion. That's money printing. I think we have a few more items on the next page. Just reiterating, the S&P was downgraded since the last time. The VIX is lower, and good Lord, look at the yield on the 10-year Treasury. At that point in time, 5 years ago, an investor could get 4.64 on a 10-year Treasury, and we're below 2 points now. So really, when investors begin investing, they need to start out with their time horizon. A short-term time horizon is a 5-year rolling period. Let's face it, I'm in my 50s, you're in your 60s, Dave. We should have 30 or 40 more years of investing, so it's 1/6 or 1/8 of our time. To us, risk tolerance, low risk means keeping your money. High risk means the possibility principal will not be returned to you. We find that a lot of individual clients have unrealistic expectations of the markets. I think it's important to point out today, institutions have reduced their expectations to annualized 7% returns. So our goal of double-digit returns and the protection mean that our risk has to be very tightly controlled. And again, to point out asset class allocation, which many investors do, meaning you're allocating to asset classes that are increasing and decreasing, is way different than what we do. We select asset classes during a very strong rise. We're looking for 10% upside with low risk. And as far as taxation, Dave and I can't control that. It's up to the government. We're proud that our clients don't have carry forward losses from the way that we manage money, and we want to continue to manage money in that way. So really, what you're on this conference call to hear is what prevented MCS from reaching a 90% confidence level last year when the market moved up, and as importantly, where are we going from here to make money in the future. So Dave, why don't you talk about the confidence level last year and what you see that's going to benefit these individuals going forward.
Well, primarily, I'm going to summarize it so I am very succinct and clear about exactly what it was last year. The two primary concerns with respect to risk last year boiled down to monetary policy and fiscal policy. Let me put those two terms in a different light. Monetary policy are the central bankers. Fiscal policy are the politicians. We now know what both of those entities are going to do going forward. They finally got together at the end of last year, and they both decided, fiscally and monetarily, that the central bankers are going to print money until they can no longer print money. That is going to artificially inflate these asset prices for the time being. In addition, the politicians, the fiscal side, they have already decided that they're going to band-aid over the real problems, and they're going to kick the can down the road on those major areas that they should be addressing, but they're not going to. They now have complete clarity with respect to what they're not going to do and what they're going to do. There no longer is a high risk factor associated with either one of those two entities.
So Dave, I think what you're saying is that after the presidential election was resolved, what we're seeing is that there's going to be no meaningful addressing of the entitlement programs, which are the biggest long-term problem. And we've already seen from a monetary side that the central bankers have gone from under $1 trillion to $3 trillion. And we see that continuing for the near future. Is that correct?
That is correct.
So our confidence level is rising. Really, a lot of people think that this quantitative easing is a new thing. We've already seen what quantitative easing can accomplish. So let's go back through a little history of our short-term track record and how it benefited the clients that were with us at that point and how it will benefit the clients that are with us now. So QE1 was launched in mid-09, and that increased earnings from $60 a share as reported S&P earnings in 2009 to $83 a share into 2010. That allowed us to get into the market in certain asset classes and return a 25% return. Subsequently, after the excitement of QE1 dissipated, the market corrected 20%. We avoided that correction. QE2 was launched, same thing. Revenue and earnings in particular, were increasing from $83 a share to $97 a share in 2011. We got in the market. We are happy to report we had an up year that year while the S&P was flat, but we didn't get our anticipated double-digit return. We only got 3% because the major unexpected news event was the downgrade of the U.S. credit rating, first time ever. Again, the market corrected 20% after that QE2 and those announcements. So Dave, QE3 was announced in September, but what happened? How did the market price it in, and how can we exploit QE3 going forward?
Well, a couple of things. They announced it in September. However, QE3 did not actually take effect until January of 2013. Just because a central banker says they're going to do something in September doesn't mean they're going to 100% do it in January, because again, they allow for changes in the marketplace between those months. But now we know they're doing it. So what is good about that is any time that we go into an asset class now and we run our numbers for both the potential upside of 10% or greater and in conjunction a confidence factor of 90% plus, which means a very low risk factor, we're more than likely going forward to get those in many cases, as opposed to in 2012 we got the potential for a 10% plus rate of return, but the associated risk was too high to gamble our clients' money in those asset classes. We had to stick to our principles, and we know the criteria works, and we're going to not change the way we invest. We're up 30% in the last 3 years since the beginning of 2010. Unfortunately, we have some clients who've been with us less than that, and the market is only up 30% in the last 3 years. We got our money early.
So really, though, going forward, the bounces have a much lower risk factor than front-running the QE, correct?
Correct.
I like this chart. It's the S&P since 1997 to present. I think many of you have seen this before. It's called a double top, and it looks like we're going to have a triple top, which is fairly common in the markets. I like to point out that in 00 and in 07, that topping process was not a one-time event. I think you can kind of see it more clearly on the 07 to 08 time frame. The market hit approximately the 1565, and it had a bounce down. It had another bounce back and retested that. That's what you're anticipating, correct, Dave?
That's correct.
So this topping process is not a one-time event, and we'll have many bounces in the market with lower risk that we can exploit. The other thing is, all of us have been investors. I would assume everyone on this call was an investor in '97. So we really have to look at what we've done over this long-term time frame. Investing is long-term, but you also have to look at those short-term time frames like 5-year rolling periods and consider how you're going to make money and, more importantly, keep it during those times. The other thing is, really, we've seen the market do this 2 times. It gets to a top, and the longer term is down. This is our MCS strategy in action, and our track record is from Q3 of 05. So we've been in the market 6 times during that time period when our criteria shows us the risk is low and the reward is great. Our track record has us in U.S. equities and some emerging markets in 2010. But Dave, you don't anticipate those to be the only asset classes we're going to be in going forward.
That is correct. We have several asset classes earmarked for relatively low risk environment with a double-digit potential rate of return this year, next year, and the year after. I can go through a few of them for you just in case you're wondering.
I think they're in a slide ahead.
Oh,
so
okay.
let's wait and go through them then. I think we have one more cycle chart that we really want to talk about. And again, this is not a scare tactic or to frighten anyone, but history tells us a lot about what to expect, not only in the markets, but in the world. And this is a Gann chart. Why don't you talk about it, Dave?
Well, this Gann chart is one of the many sources that we use to determine where the projections are going forward with respect to unbiased opinions and rather straightforward mathematical assumptions. Now, we don't necessarily 100% agree with this chart. Let me make that perfectly clear. Our analysis shows that the likelihood of this chart occurring in the future is about a 70% likelihood at this point in time. However, let's assume for a moment that it does end up the way that this chart indicates it will. Take the left-hand side of the chart, flip it over as a mirror image onto the right-hand side of the chart. All of those downs and ups, bounces, and downward movements, we are going to be able to exploit most of those. Why? Because of the clarity. The uncertainties with respect to monetary and fiscal policy are pretty much gone.
Well, that's encouraging, but what could other investors face who really don't have that insurance part on their portfolio?
Well, again, in our opinion, the likelihood is that there's going to be a 10% rise in the market going forward. There's going to be a 20% sideways movement within a channel of about a 20% top and bottom, and there's a 70% likelihood the market is going to go down 25 to 60% over the next several years.
Wow, that's pretty negative.
Well, it's extremely negative, but we don't really care because, again, we will be able to exploit those situations because at some point the central bankers are going to have to decrease the liquidity, and that's why we think there's such a high likelihood, 70% if you will, that the markets are going to bounce in a downward pattern.
Also, the bond bubble could burst, and I say could, but it's pretty evident when we have a reduction on yield from over 4% on the 10-year to 2%, that long-term holders of bonds are going to be in for a rude awakening.
A very rude awakening. And if you want confirmation on that from your central banker, Ben Bernanke, they are overly concerned now that their portfolio of $3 to $4 trillion of bonds are going to suffer a loss if they try to sell those bonds prior to the maturity dates.
So a lot of people want to know how external factors affect our model. We really don't have a model. We have principles of investing that include fundamental, technical, and economic analysis. So we know many uncertainties have been cleared up temporarily. Fiscally, we know who got in, who won the election. We know the House and the Senate. Monetarily, we have QE unlimited, and QE already allowed us to enter the market twice so far. So we certainly expect these bounces will be much lower risk and increase people's portfolio that were not with us in 2010. But we also see some things happening in the emerging markets that could allow us to exploit emerging markets, correct?
That's correct. What the central bankers are doing right now, Japan, the Eurozone, Great Britain, and the United States, they're pumping and printing money, if you will, into the systems in order to reduce or weaken their currencies. And that reason is to allow exports to be cheaper so that they can grab a larger world market share of their goods and services.
And our U.S. government is kicking these fiscal problems down the road. I mean, we barely had a blip with this sequester, but we know entitlement problems have to be addressed, and when they are, that certainly could affect that chart, that scare chart negatively. But right now, we're not worried about that. So what are your current confidence levels, Dave, and what can we expect in the near term, meaning this year?
Well, as I said, in the last month or so, these asset classes that we've been looking at, we have a greater than 80% in several of them. All we need is a 90% plus associated with a potential rate of return of 10%. We pretty much know that we're going to get the potential rates of return in these asset classes. Once we get those 90% plus factors associated with those, we can then exploit the market and not gamble with the money, but rather invest it wisely, get the appreciation, and go home with the money and keep it.
So the super thing is that we can go to all classes, asset classes, not just the U.S. equity market, and we're fully anticipating doing that in the next few years.
Correct.
Not much has really changed with our daily scan list. We highlight areas in green that we anticipate the near-term double-digit returns from, and that would include the U.S. market, the emerging markets. The bond market, we could have we could make money as bonds decrease in price and with the bounces. We like technology and energy sectors, and I know you're watching the commodities market, especially precious metals like gold and silver.
Correct.
So why don't we wind it up here and really give a ending here with what we see for 2013 and beyond.
Primarily 2013 is going to be what I consider to be a transitional period with respect to the U.S. markets and the global environment. What I mean by that is that GDP is at an anemic pace right now within the U.S. Obviously, the Eurozone is in a recession. China is slowing down. These things are going to affect the way that goods and services are purchased or not purchased. They will affect companies' profitability. Revenues and earnings of these companies, both domestically and globally, have been significantly lowering the growth rate over the past several quarters. That is going to continue. If you have a slowing revenue and a slowing earnings per share environment, trust me, it's not long after that equities will be affected in a negative way. However, they will go down and then they will bounce up because the market has a tendency to always undervalue and overvalue securities at certain points in time. But the trend will be basically sideways and down.
For long-term investors, but our investors understand that really the numbers on the market don't really mean that much to us. It's the ability to jump in, grab the profit, and keep it going forward.
Yeah, one thing I want to caution everyone about right now, if the market is going in a negative annualized rate of return, and we're positive, we are not taking on more risk. We are merely exploiting the low risk environment at that particular point in time and getting out at a particular point in time shortly thereafter. Do not make the assumption if we're up 10, 20, 30% in the next year and the market is down 5 or 10 or 15% that we've taken on more risk. We have not.
You know, that's interesting, Dave, because we are out of phase with most other investment strategies, so I like the fact that you pointed that out. So just in closing, fiscal and monetarily, uncertainties have been cleared up, and we're looking forward to exploiting those, all those opportunities in all those asset classes. So we're going to open it up for questions, but wanted to show you briefly our performance net of all fees, and I do have to put up the disclosure page. So please ask questions, and we look forward to talking to you soon.